Welcome back to another episode of Palisade Radio. This is your host, Colin Cattell. On the show with us today is a new guest to the program, Sam Pelaez. He's the Chief Investment Officer and Portfolio Manager at Galileo Global Equity Advisors, which is based in Toronto. Sam, welcome to the program.
Thank you, Colin. It's a pleasure to be here.
Well, I saw a chart that you put out a short time ago, and I wanted to get you on the program to discuss it. It looks at the comparison between the S&P 500 and the commodity market. And people can, as a commodity investor, one can say that, it seems that we're off the bottom since 2016, but it's important to draw that comparison to the overall equity market and put in perspective just how cheap things are. So the question is, where are we and how cheap are things?
Yes, and I'm actually really glad that you asked me about this chart because it's one of my favorites. And what the chart plots is the S&P Commodities Index divided by the S&P 500. So you can think about it as the commodities world divided by the broader U.S. equities market. The interesting thing about the chart is that it shows that we're at the lowest we've ever been. What that suggests is right now, if you sold 1 unit of your market exposure, you could buy the most amount of commodities that you could have ever bought in history. Now, the chart goes back a good 50 or 60 years. And what it shows is there's been 2 times in the past when the same index has been stretched similarly to where we sit right now. And what followed after those extreme moments were 2 huge bull commodity runs for commodities. The most recent one was right after the NASDAQ peak in the year 2000. We had about depends on how you calculate it, 8 to 10 years of one of the most exceptional commodities markets we've ever seen, coincided with the industrialization of China, and obviously was the right place to be for that, for that whole decade. And right now we're sitting in a similar predicament. And obviously I'm not, I can't see the future, but if you follow the chart, it suggests that maybe we are in the same position and we could see this, incredible commodities run that could last as long as a decade.
Being that the chart is right in front of me, it is pretty clear to see that this is the cheapest that it's been in ever, but it certainly reckons back to the 1971 low, which appears to be in a similar spot in the chart. I remember seeing this chart or something similar to it about a year ago and thinking, wow, this seems to be the bottom, and then here we are. It has gotten a bit more exaggerated. Do you feel that a turnaround is imminent in terms of when this ratio is going to flip back?
Absolutely. And well, you have to keep in mind that we're talking about a 50-year chart here. So you can't point it to the day or to the month or the week, but certainly we're in this situation where you should gradually be rolling exposure into commodities on a weekly or monthly basis or quarterly basis, whichever you normally choose to rebalance your accounts and your portfolio. But back to the original question, this year has been a pretty challenging year for resources. The brunt of it has been the trade war and how that's sort of like taken over the media. It feels like every day we wake up to some more details or more confrontations. President Trump arguing, in favor of imposing further tariffs on imports. But when you think about the longer term, what I'm trying to say is I feel like this trade war angle is more short-term in nature. It's part of a negotiation tactic. It's to nobody's benefit, neither the U.S. nor China or anybody, for this to evolve any further. So if anything, I think this is just a negotiation tactic to advance some international policy agenda. And while people are being distracted by these headlines in the back, China is working on a major infrastructure development program called the One Belt, One Road. I'm sure many of the listeners would have heard about it, where they're essentially industrializing over 24 countries that were formerly part of that Silk Road. Similarly, in the U.S., one of Trump's big campaign promises was an infrastructure build-out. Obviously, after the big monetary expansionary policy that we had over the last decade, now it seems that it's the fiscal policy that needs to take charge. And the best way to do that is through, one, taxes, which already were introduced, like tax cuts, and the second one is fiscal spending on infrastructure, which I suspect is what we're going to see next. And actually, if you've been to New York recently, you would have seen that LaGuardia looks nothing like it used to. Billions of dollars are being spent there, and probably in all of your communities, you can pinpoint specific projects that have started moving, and hopefully we're going to see more of them. The rest of the world continues industrializing. Here in Toronto, when you look at the skyline, there's cranes everywhere. So the demand for commodities has not softened. It actually has continued to increase both in China, the U.S., emerging markets, wherever you look, the demand is strong. Now, the short-term angle, the short-term concerns about the trade war have, led to a pretty sharp sell-off in commodity this year. But if anything, that's just even a better entry point for listeners or investors as a whole to get exposure to commodities.
Sam, when looking at a 50-year picture, I think it's safe to say that in general, commodities seem to move up and down together, but there's always this talk about separating the precious metals from the industrial commodities because the demand for the precious metals is more monetary based, and the industrial metals, of course, is for global growth and demand. Are you looking at them together, or do you think that they have a separate narrative?
I look at them together in the context of comparing them to the rest of the other sectors. So right now is a great time for all commodities, energy, and materials. But once you start digging deeper, obviously they have different dynamics. They tend to trough and peak at different parts of the business cycle. In the case of gold, this year has been what should have been a pretty positive year for the yellow metal, and it hasn't been actually. Gold is down, give or take 7% year to date, pretty sharp. The biggest reason for that is the strong dollar. And the dollar has been strong mainly on the back of Powell and the Fed continuing to raise rates. But if you drive and if you've been to the pumps, you will have noticed that gasoline prices are up something around 50% from July 4th last year to July 4th this year. So inflation is creeping in. We shall see inflation continue to rise, and that will erode some of that interest rate growth that we've seen from the Fed. And I think that's going to stall the advance in the dollar. And as the dollar starts to stall, we should see gold recover.
In terms of exposure that you've been looking to get to the space, I know that you're quite bullish on the royalty and streaming space, so certainly something I'd like you to speak to. But on top of that, how do you see best fit for investors to get in and get exposure to commodities when they're at a historic low?
This is sort of like two angles, and obviously I just spent the last 10 minutes telling you how excited I am about this part of the cycle and how commodities are going to rally. But the investing we do generally, we look for companies that can outperform in any part of the cycle. We like companies that have strong business models that allow them to outperform their peers and even give you absolute performance in times when the commodity may be in a negative position. So in that context, the royalty companies have a superior business model that allows you to invest with them at any part in the cycle and expect, revenue per share growth and expect the exploration growth and production growth through their investments to give you that alpha even in a down part of the cycle. And that mentality permeates most of what we do here at Galileo. We try not to be market timers. We don't invest based on headlines. We invest based on long-term ideas and fundamentals. So as part of that, we have a product, or essentially all of our funds are crafted the same way, but we have a gold product that seeks to replicate that investment mentality, so that investors and advisors all over the world can get access to our investment expertise and sort of investments with that type of mentality.
In terms of the exploration space, which oftentimes can yield those 10 or 50 or 100x returns that many speculators dream about in the resource space, how do you guys look to capture some of that side of the portfolio, or are you focused more so on the proven and strong cash flowing operations like the streaming companies?
Well, we offer different products with different, obviously, strategies. But most generally, we like to allocate the bulk of any portfolio to royalty companies, stable producing companies that have demonstrated to have solid capital allocation, to be exceptional management teams, to be frugal, to offer you revenue per share growth or resource per share growth. But we always have room for for those unique opportunities that we come across being so deeply involved in the sector, especially in the junior space, to have those 100% baggers. So one of the funds that I run, we have a rule where we seek to invest based on our model allocations, 80% of the fund, the other 20% of the fund, we invest in a larger number of small constituents that we believe have that optionality and have the right management team and the right asset to offer you the opportunity to have one of those 100 baggers.
Excellent. Well, Sam, for listeners interested in finding out more information, getting on a reading list, or getting in contact with you, what's the best way for them to do that?
The best way for us to reach us is obviously through our website, galileofunds.ca. We also have a LinkedIn page. We're trying to reach to the younger generations through an Instagram site or page. If you just look for Galileo Funds, even on Google, I'm sure you will be able to find us.
Excellent. Well, Sam, thank you so much for coming on the program and addressing our audience today.
Thank you, Colin. It's my pleasure.
Think you understand the junior mining sector and you think that the participants in the mining sector, junior mining sector, are good people and kind people, hit the bid.
How violent that term could be, it actually could be quite violent. It could be a rip-your-face-off uranium rally.
And the world is always going to need raw materials. It's going to need copper and gold and nickel and so forth.
Totally destabilized. Hey, Troll, did you hear what's going on in Yemen?